gosh, if I had the answer to that, I would be, investing in different.
I think that's utterly wrong.
And I would say we're actually torn about it.
I think that was one of the best questions I've heard. But really, I think you should just go for it, really. Somebody's shown the faith in you. Yeah, shop around the terms, but trust that person. Well, it's almost like questioning, do you believe in love at first sight? My now wife moved in, you probably don't need to know this information, but moved in within days of meeting. I kind of made that commitment. That was my term sheet moment.
And so we sit on made.com couches.
Can I do a disclaimer that we don't just sit around on couches anyhow?
By the way, VK, I think we can call it a beta product now, given this is episode 4. The simplistic answer that all VCs tend to give is 18 months. And the reason why people say 18 months is because fundraising is generally quite an arduous process. It takes 3 to 5 months or so. And what that means is that gives the founder then a year to basically put their head down and not worry about fundraising, work on product, work on sales, work on all the metrics that they need to prove for the next round. And so that is the simplistic answer, but I bet Rogan's probably got a better answer than that.
The reality is that this is an art, not a science, and it's a reasonably ludicrous valuation methodology where it's all really about dilution. So you should go for as much money as possible, gives you as much time to prove things as possible. And your kind of limiting factor is, by definition, your valuation will be 3, 4, 5 times your ask. If that's an insane valuation for where we are, both in the cycle and in your company, you're not going to get it. But you don't. And it all comes down at the moment to dilution. So from a founder's point of view, obviously, the least dilution, the better. From an investor's point of view, the higher stake, the better. It's where we all want between 20 and 30% for every round.
But Rogan, it's probably worth explaining to the audience as well about why each round generally buys 20 to 30%. And a lot of that is the economics of venture capital funds and how we make money, right? We need to own a meaningful stake at exit of a business to be able to generate a large return for our fund. So we will make 20 or 30 investments. We only expect 5 to 10 of them to really generate significant capital back. Those 5 to 10 need to generate 3 to 4 times on our fund, which means we need to own a meaningful stake of the business at the end of the day, which means we need to own an even more meaningful stake of the business when we first invest.
You should be able to, because, let's face it, we all try things on and then maybe we'll come back with a lower offer. It's the kind of classic market trading technique. You want 100, no 1. Okay, I'm walking away. Okay, it's yours for 3. Unfortunately, just to be pragmatic, I don't think that does work. Well, 2 things really. Let's say you originally pitched a 7 and then you come back for 3 million. It makes it look like you weren't successful at the 7, which loses some of the momentum. I think the second thing that people could say is, look, to be a really, really good entrepreneur, one of the skills you need is the ability to fundraise, and you need to know what the journey looks like, and you just properly screwed up in the first time. I'm less about that one, but the first one is definitely the way people...
No, but...
Different participants invest at different stages and at different amounts. Some people will get off the ground purely by bootstrapping. Some people will have friends and family. But a lot of people can't do that either because they can't afford to. Bootstrapping requires you to be able to not spend money. So it does require either another source of income or some capital. Friends and family requires wealthy friends and family by definition. So angel funding, I think, is an excellent way of getting to the next stage. And indeed, increasingly, I think there are some angels out there, super angels, who are writing checks as big as co-founders checks as well.
So we really do believe in the power of having an additional person or company around the table, the network they bring, the additional capital they bring, etc. You can take it to extremes as well. So let me give you an example. If it's a €1 million round, the options could range from having one venture fund write a €1 million check through to 10 venture funds writing €100,000 each. Let me tell you what really doesn't work is 10 venture funds writing €100,000 a piece into a company. It's not meaningful to them. There's too many. They assume someone else is doing all the hard work. And so there's a fine line to tread between those two extremes.
I think that was one of the best questions I've heard. So let me show you the pros and the cons. Small stake from a big fund means that you won't get the attention, means that the necessity to follow on isn't really there, but the expectation at the next round of follow on will be there. So some of our worst mistakes have been when a big fund has written a very small check, and then really, because it's not that important, they haven't focused on it for the next round, and that's destroyed the round. A big check from a smaller fund has the benefit of you being properly important to that fund, and so they will care a lot. They will also annoy you a lot and ring you up a lot because all of their eggs are in your particular basket. And they won't be able to follow. But I think you've got a decent story there anyhow. And broadly speaking, I think that it's not a bad thing to, in inverted commas, prove to others that you can raise from more than one person. So not following isn't terminal if there's a rationale for it. Yes, you should, from a founder's point of view. Obviously, from an investor's point of view, it really freaks me out. And we're trying to think of ways that we can allow people or encourage people to shop it around, because actually we shouldn't be scared of people shopping it around from a kind of changing valuation, changing terms, because there is no kind of magic answer. So we should be perfectly prepared to accept market terms. I think the worry from a VC's point of view, honestly, is that it gets shopped around to a, in inverted commas, better fund. Now, of course, we don't think there is anybody better. But really, I think you should just go for it, really. Somebody's shown the faith in you. Shop around the terms, but trust that person.
So I'm going to be a little bit self-serving in this answer, but I don't think VCs truly have a desire to collude against companies. Part of the reason that founders struggle with this is they think if I put two VCs together, they're going to try to harm me. But I actually think what we end up doing is we end up talking each other into the deal more. So I wish founders actually connected us together with other intrigued investors sooner, because that social pressure, someone else is also meeting with this company, they're quite intrigued. I think that actually drives positive momentum within it. That's it. It's very time consuming for people to have to go out and raise additional capital. But of course, it depends on how it's structured. If there's an investor that basically says, I will fund you every single month until you raise money, that might not be a huge amount of effort. But you're right. Optically, it looks like you're not able to go out and raise the large round. And so that's, I think, the biggest thing that you have to struggle with is how you explain to someone that about why this money is coming in piecemeal to the business.
And this is just an optics. I mean, there is actually a huge amount of sense from a capital usage point of view, from an investor's point of view, to not do it all at the beginning, but to stagger it over various months. But I think the way to do that is to have it as guaranteed coming in, not as I might or I might not put it in, because at that stage it becomes less commitment. It looks like you haven't proved enough to get in new investors, and that B, the existing investors are only half sure about whether they should be continuing, and they're throwing a bit more money in to give you some time to maybe prove the wrap. I think COVID-19 and the current situation changes everything really towards that for two reasons. One is obviously the future fund, if people want to be matched by the future fund in the UK, that it is a convertible by definition. But also, I think that one of the big uncertainties at the moment is what the hell valuations should and could look like, and what the signalling is by putting in a price round now. So actually, I think there'll be a lot more acceptance in 6 to 9 months' time or 12 months' time of people who've raised convertibles in this period than before. This is almost a kind of one of those put it up and let me slam it down. In the past, venture debt has probably been seen as a alternative if you couldn't raise equity. So better to raise equity, but if you couldn't, then it's venture debt. I think that's utterly wrong. I think as an industry, we should be encouraging founders to use more venture debt. And I think that founders should be excited actually by the prospects of using venture debt, because it reduces their dilution. It does add to the risk factor, but let's face it, there is no founder around who doesn't realize and isn't taking an enormous risk anyhow.
Okay.
If you're optimizing around capital structure, yes. But I think what you're trying to do is you're trying to minimize the degrees of risk freedom, if you will, in this case. And having venture debt ins usually means covenants and
no, it doesn't anymore. I think venture debt providers are being super pragmatic.
Yeah, you have to look very carefully at the terms.